Good evening, everyone. I'm Cammie Bassett, Co-Director of Programs for the League of Women Voters of the Palatine area. We serve Palatine, Rolling Meadows, Inverness, Schaumburg, Hoffman Estates, and many surrounding communities. Although we have women in our title, membership is open to anyone 16 years and older interested in participating in government. We are proud to be nonpartisan, neither supporting nor opposing candidates or political parties, but always advocating for vital issues of concern to the public. We work to register voters, provide voters with election information through voter guides and candidate forums, and sponsor educational programs of this nature. Now for a little housekeeping, you will all continue to be muted during the presentation. If you have questions you wish to be addressed by our speaker, please type them in the chat. Once Mr. Martire has completed his lecture, we will then attempt to go through as many questions as time permits. My fellow league member, Kathy Martin, and I will monitor the questions. Right now, I suggest you put your screen on speaker's view so that when Mr. Martire is speaking, that you can focus on him. Before we proceed, I'm going to post an anonymous poll on the screen. We need your help in trying to figure out what are the best places for us to publicize our events. First, please answer where you learned about this event. Okay, I think we have enough, Dale. I'd like to introduce tonight's speaker, Mr. Ralph Martire. Ralph received his BA in history with highest honors from Indiana University and his law degree from the University of Michigan. Currently, Ralph serves as the Executive Director of the Center for Tax and Budget Accountability, a bipartisan think tank committed to ensuring that state, federal, and local workforce, education, fiscal, economic, and budget policies are fair and just, and that they promote opportunity for all, regardless of race, ethnicity, or income class. During his time at the center, Ralph has helped obtain numerous legislative successes in education, taxation, and corporate accountability through bipartisan measures. Ralph has received numerous awards, including the Champion of Freedom Award, presented to individuals whose professional work embodies Dr. Martin Luther King Jr.'s commitment to equal educational opportunities. The Brian C. Hubbard Leadership Award, given individuals who have greatly benefited education in Illinois, and the Adelaide Stevenson Award for Public Service for his outstanding contributions to government and public administration over an extended period of time. Ralph is also the Rubloff Professor of Public Policy at Roosevelt University. In addition to his professorship at Roosevelt, he has taught fiscal policy seminars and education finance courses for various universities and the International Fulbright Scholarship Program. In addition, Ralph is also a regular columnist on education, fiscal, and economic policy for the State Journal Register, the Daily Herald, and the News Gazette. Mr. Martire, I'll pass the screen to you now.
Okay, great. Let's get that PowerPoint up there so that they could focus on something other than my mug. And while that's coming up on the screen, I'll let you know that the Center for Tax and Budget Accountability is bipartisan. So my board of directors has Democrats and Republicans on it that neither like nor trust each other very much. And so that's great for us at the staff. We just focus on best practices and data. Now, perfect. And so that is the state's budget for fiscal year 2021. And the reason we're starting here is it's really hard to understand why the state of Illinois needs to reform tax policy at all, much less pass something as controversial as the fair tax is, unless you can put it in context of the state's budget, its spending priorities, its spending needs, and its revenue problems. So as this graphic shows you, the state of Illinois is going to spend $42 billion this year if you look at the very top column. That's the net total expenditures. That said, 14.8 billion of that amount are hard costs. These are things the state has to pay by law, and we've identified them in that subcategory too. So it's things like debt service, the pension contribution, other small statutory transfers out to things like the road fund and Medicaid funds, et cetera, and group health insurance on state workers. So that 14 billion is spent without anyone taking a vote on anything. Then you get down to the third category heading, general fund service appropriations. This is where the elected officials like the governor and the General Assembly vote to determine how they're going to spend taxpayer dollars among different priorities. And one thing that jumps up to the front of the table right here is that 96% of all their expenditures on services, that's 96 cents out of every dollar, go to only four things: education, healthcare, social services, and public safety. Yeah, education has three subcategories: early childhood, K-12, and higher ed, but they're still all key priorities for the state of Illinois. Now, one line I'm going to point out right here is the next to last line called unspent appropriations. That simply means of the amounts appropriated to spend this year above that line, they're not going to spend $1 billion. We don't know what's going to get cut yet. So the appropriations you see here in this graphic are really the maximum possible spending. They're not necessarily the total expenditures. But one thing this graphic really makes very clear is 96% of the state's money that is spent on current services really goes to the priorities voters and taxpayers want: education, healthcare, social services, and public safety. There's not a lot of waste, fraud, or abuse in this kind of a budget. And in fact, Illinois is very lean and mean. I'm not here to say there's no waste or fraud in the state budget. This is Illinois. We should probably have a line item for waste, fraud, and abuse just to give them their 50 or 100 million that they're going to piddle away on meaningless stuff. But the bottom line is the state spends our money on really good things. And the bad news is it can't afford to keep spending on these things. Next slide. Now, how do I know that? And the answer is pretty simple: the state's deficit. So how big is the deficit? Well, let's look at our revenue and compare it to what we have to spend. So first of all, they are projecting $42 billion in revenue this year. Now, out of that $42 billion, the first thing you have to cover are those hard costs, the things the state has to spend on by law or by contract. And if you recall from the prior slide, that's $14.8 billion for this year. So you take that off the top, and that leaves $28.1 billion in revenue, which sounds right because at the end of the day, they're going to spend $28.1 billion on services. The problem is, in public sector accounting, they do not have to report any accumulated deficit left over from the prior year. Now, when you hear an accumulated deficit, you should really hear unpaid bills. So the state of Illinois this year is going to inherit $8.4 billion of unpaid bills left over from fiscal year 2020. Now, by law, they're going to have to pay that out of this year's current revenue before the end of the fiscal year. So let's take that out, because that is a legal expenditure they're going to have to make. And that leaves only $19.7 billion in revenue. They are going to spend $28.1 billion on services, as you see in step 3, meaning the deficit stays in unpaid bills at about $8.4 billion. But that's not the real deficit. the year is going to end with. How do I know that? In that $42 billion revenue figure I started this graphic with, $5 billion isn't really tax revenue, it's loan proceeds. The state of Illinois, because of COVID-19, is going to take out a $5 billion loan this year under a federal program. Now that's great. That'll support $5 billion of expenditures this year. However, that $5 billion doesn't exist to be spent next year, and in fact has to be repaid, which means the real deficit going into next year is $13.3 billion. That's so significant that if the state of Illinois next year just wanted to invest in the same level of education, health, social services, and public safety that it provided this year, it's going to be short by 47%, almost 50% of the revenue it would need to just maintain its expenditures in those four core services. Next slide, please. So, what has caused all this problem? And historically, it's been a structural deficit. And this is a model of how bad the state's structural deficit is. And when I say the word model, you should all cringe, because anyone there that's familiar with statistics knows that if you're good at statistics, you could take a quote unquote model and based on how you jury rig its assumptions, make it dance to any tune that you want it to dance to. Now, we don't jury rig things at the Center for Tax and Budget Accountability. So our models, whenever we do them, are sent out to independent peer review by 4 different PhD economists, including the head of state and local tax at the GAO in Washington, D.C. So what does this picture tell us? This picture tells us why your property taxes are too high, why we've got underfunded pensions, and why the state's general fund always seems to have a deficit no matter how much they cut spending on services. Go to the far left-hand column of this graphic. That's fiscal year 2019. We assume the state started with a balanced budget that year. It did not. It had an $8 billion deficit, as you now know. But let's assume that it had a balanced budget. If you just adjust for historic rates of inflation and population change, and you assume a normal economy, will our revenue under current law continue to support the same level of services the state provided in fiscal year 2019 onwards into the future? No. So the yellow line shows you the cost of continuing to provide current services into the future, literally just adjusted for historic rates of inflation and population change. It assumes a normal economy. It assumes no changes in law. The other thing added into that cost line, of course, are the debts that the state of Illinois has to pay. These aren't adjusted for anything. We just put in the dollar amount of the debt service payments the state has to make every year. The red line underneath it shows you how our revenue is projected to grow given the same circumstances. No changes in law, historic rates of inflation, normal economy, etc. The bottom line is, our revenue will not grow at a pace necessary to maintain our current expenditures on services into the future. This structural deficit has been going on since at least the early 70s, maybe late 60s. What's it do? It encourages elected officials to avoid the problem. Why does it encourage elected officials to avoid the problem? And the answer is simple. The only way you solve a structural deficit in a sustainable way is to either raise your taxes up to the level of your spending. Guess what? Tax increases aren't politically easy to do. They aren't politically popular. So politicians in both parties avoid trying to do tax increases. Or you could just hack your expenditures way down to your revenue levels. Well, when you're spending 96 cents out of every dollar on education, healthcare, social services, and public safety, if you're an elected official and you're whacking those items by huge amounts every year just to balance your budget, you're not going to get reelected. So instead of either completely hacking spending on services or raising taxes, the state decided to do two things. It pushed the primary obligation for funding K-12 education away from state tax revenue and onto local property taxes. This is why property taxes in Illinois are in fact high. The state decision makers decided to hide their deficit by shifting this primary responsibility to fund schools down to local property taxes. The other thing they decided to do was say, let's just not fund the pensions the way we're supposed to. So instead of covering what's called the normal cost, the contribution they should put into the pensions every year, they instead said, hey, we're going to write an IOU to the pension systems, take the money that should have funded pensions, and instead use a portion of it to hide the structural deficit and support current expenditures on services. In other words, they borrowed against what was owed to the pension systems to pay for current services. Borrowing to spend is not sustainable. And then they passed a repayment plan in 1995 to cover this debt service called the pension ramp that is so ridiculously backloaded, the state will never be able to make the payments. And I have a slide on that coming up in a minute or two. So next slide, please. So the question really becomes, did spending contribute to the structural deficit? Are we overspending on anything? Or is it really the revenue problem that Martire and all these other people say it is? Well, the answer is it's very much not a spending problem. Now, this is a bit of a complicated graphic, but I want you to stay with me. Go to the far left-hand column there. That is what the state of Illinois spent on all those core services, education, healthcare, et cetera, in fiscal year 2000, 2 decades ago, under then Republican Governor George Ryan. The second column right next to that is just the inflation adjustment of that 2000 expenditure put into 2020 dollars. So if you wanted to just stay level in funding, what you spent, let's go to the top line, $4.6 billion on for K-12 education in fiscal year 2000, this year you'd have to be spending $8.2 billion on. That is equal after you adjust for inflation. In real terms, that's the same expenditure. Third column is what we've actually passed in our budget for these line items. And the fourth and fifth columns are whether there has been an increase or a decrease in spending after you adjust for inflation in dollars and by percentage. So the first thing to note is the bottom right-hand corner. We're spending 20% less collectively on education, health, social services, and public safety this year in real terms than what we spent 2 decades ago in fiscal year 2000. That's an amazing cut over a 20-year period. Now, a couple of things did see an increase, and we'll highlight those. K-12 education is up by a whopping 1.39%. Oh my, right home on. And the amazing thing about that increase is it all occurred in the last 3 years. 3 years ago, the state of Illinois passed a new school funding formula called the evidence-based formula. And under that formula, the state is supposed to put $300 million more into K-12 education every single year than it did the prior year. And in fiscal year 2018, 2019, and 2020, the state did in fact do that. And it's only because of those 3 straight investments totaling up to $900 million over 3 years that the state is actually spending more on K-12 today than it did way back in 2000. So there's the good news. It's finally spending more in real terms. Here's the bad news. According to the Illinois State Board of Education, we're still $7 billion short of funding an education that the evidence indicates is necessary to provide an educational opportunity that permits all students the chance to learn and succeed academically. 7 billion short. So we're nowhere near meeting need. And then in the second line, you see a pretty significant increase for early childhood, 81% in real terms. That's great. And everyone knows it's a great investment to put money into early childhood. You reduce long-term criminal costs, you reduce healthcare costs. It's a very good thing to invest in. Then, of course, this is Illinois, so here's the bad news. The total expenditure this year is going to be $544 million. The demand for early childhood services in our state is north of $3 billion. So while we've increased this investment and increased it substantially, and it's enjoyed bipartisan support, Governor Rauner increased it, J.B. Pritzker increased it, so Democrats and Republicans both have been for increasing this, we're nowhere near meeting need. Once again, we are way below satisfying demographically driven need. Then go to the next education line, higher ed. Look at what higher education got from the state in 2000, $2.1 billion. Ignore the second column, jump to the third column. This year, it's only going to get $1.9 billion. In other words, we're going to invest less in nominal, non-inflation adjusted dollars in higher education this year than we did 2 decades ago. That's outrageous. And in fact, after inflation, it's a cut of 48.7%, almost a 50% cut. Next slide, please. That's had ramifications, of course. And here they are. And this is a painful slide to look at. Go down to the far left-hand corner again, fiscal year 2002. In that year, the orange graphic, part of the graphic, shows you the state level investment in public institutions of higher learning in our state. It covered 72% of the cost of a student attending a public university. The yellow bar, it's called university income funds, it's tuition and fees. Tuition and fees only covered 28% of the cost of a student attending a public university in our state. Then Rod Blagojevich in 2003 and 2004 decided we should really start cutting our investment in higher ed. Called them fat cats, this, that, and the other thing. Basically, if policy could be done the wrong way, Rod Blagojevich sought it out and then went ahead and did it. So he started really cutting higher ed. Now go all the way to 2019, the far right-hand column. So much so that today, state transfers to higher ed only cover 32% of the cost of a kid attending a public university, while tuition and fees now cover 67%. Our growth in tuition costs for public institutions of higher learning in our state has outstripped the national rate of growth for tuition in public universities by over 50 percentage points over this period of time. We are pricing our state from a tuition standpoint into a completely non-competitive situation. We're also harming the ability of low-income and moderate-income families to send their kids to public university, public community colleges in our state. In fact, this has a disproportionate impact on Black and brown kids. So next slide, please. So I told you, when you have a structural deficit, the state of Illinois tried to cover it by doing a couple of bad things. And one of those bad things was shifting the primary obligation for funding schools down to local property taxes. Here's your proof. So if you look at these two comparisons, Illinois is the red bar and the national average is the blue bar. Go to the comparison on the far left. Nationally, in a state, local property taxes on average cover 44.9% of the cost of public education. In Illinois, property taxes cover 67%. We rely more on local property taxes to fund schools than any other state in America. We're the outlier. Then you flip it, the states on average cover 54% of the cost of public education, and Illinois only covers 38%. So once again, we're the outlier here. We rank 50th in the nation in the portion of education funding covered by state rather than local revenue. So we've basically tied the quality of public education to the quality of public education a child's going to get in Illinois to the property wealth of the community in which the kid lives. That's a horribly inequitable way to fund schools. You want the state to bear the primary responsibility to fund education. But this isn't just inequitable from a school funding standpoint. Next slide, please. It's also highly inequitable from a tax policy standpoint. So we just took out the impact of inflation, and in real terms, since 1990, property taxes are that orangey bar. They grew by almost 70% in Illinois, property tax burden. Median income grew by only 11%. So property taxes are growing by 6 to 7 times the rate of growth for most people's income. That makes it very difficult for people to pay their property taxes. And let's face it, you don't pay your property taxes by digging up a piece of the lawn and mailing it in. You have to pay it out of your income. So when when your tax burden for property taxes is growing at a pace that greatly outstrips your growth in income, this takes away from your ability to provide for your family. What's really galling about this is if you look at total tax burden as a percentage of income in Illinois, we're relatively low. We have the 5th largest economy of any state in America. We have the 6th largest population. The total state and local tax burden, when you include every tax and every fee charged by any unit of state or local government, as a percentage of income, we rank 27th in the country, bottom half. However, property taxes, when you isolate the property tax, we're always in the top 3. So despite being low tax overall, we're very high tax on the property tax. The reason? Structural deficit. Structural deficit exists because our revenue doesn't support our current services. And it's not because of overspending. I hope I convinced you of that with the prior slides. It is in fact because we have a real big revenue problem. Next slide, please. Property taxes aren't just a lousy way, over-relying on property taxes isn't just a lousy way to tax people, it's a lousy way to tax businesses. So this is total business tax burden in Illinois as reported by Ernst & Young, the top accounting firm. And what you could see is for a business, 45% of what they pay in taxes, of all their taxes, is property taxes. Go further down to about the middle of this graphic. Corporate income tax is only 4% of what a business pays in taxation. Go a little further down the graphic, individual income taxes. See, businesses that are flow-throughs like S corporations, partnerships, LLCs, they never pay corporate income tax, they're exempt. The owners of those businesses pay personal income taxes on the business's profits. When you count that as a corporate tax burden, business tax burden, because it technically is, even though it's being paid by people, you see it's only 4% of all the taxes paid by businesses. Really, if you want to reduce business tax burden in Illinois, you got to focus on the property tax. The only way we could bring the property tax down is if the state of Illinois does an adequate job of funding education from state-based revenue. Can't do that with its current tax policy. Its current tax policy doesn't work, so we're going to have to change our current tax policy to generate adequate revenue to hopefully take some of the burden off of this property taxes for people and for businesses. Next slide, please. Well, then I said, the other bad thing it encourages state elected officials to do is to borrow against their pension obligation and then defer the repayment of that debt down the road. That's exactly what the state had done for decades and decades. And in 1995, they passed what's called the pension ramp. And the pension ramp created a series of payments pursuant to which the state would put back into the system what it intentionally underfunded to divert what should have gone into the pensions to instead hide its structural deficit. These payments, you add the two bars together you see here, these payments are the total payment required under the pension ramp. Now, what I've done for you is broken the payments down into their component parts. So start with 2019. The pinky tan part of that payment, that's the normal cost of funding benefits. The blue bar, that's the debt service payment. That's repaying what was borrowed. Now just look at this graphic. What do you think the problem is? Is it the normal cost of funding pension benefits being earned by state workers, that declining pink thing? Or is it the cost of repaying what was borrowed through that backloaded debt plan? Don't think too hard. This is not a trick question. I mean, obviously, the deferral was insane. So insane, I'm just going to throw you out some numbers. So some fiscal year 2020 to 2021, last year to this year, the jump in the debt service payment under the pension ramp was over $500 million. Year-to-year jump. Our total general fund revenue growth from all sources this year was about $180 million. The jump in debt service under the pension ramp consumed about 3 times the rate of growth for all of our revenue. And by the way, that revenue growth figure I cited was before the impact of COVID-19. That's in if we had a normal economy. So the bottom line is this backloaded pension ramp that's crushing our state's finances is the product of generations of borrowing against the pensions to hide the flawed tax policy that led to the structural deficit, where our revenue growth every year was not quite enough to continue providing the same level of services delivered in the prior year. Next slide, please. Now, we're going to get into some details on the fair tax in about 3 slides in some great detail. But one of the things I want to make very clear, and I make clear in every presentation, is that, you know, the fair tax proposal that's on the table does not solve all the state's fiscal problems. And in fact, no person, no organization, and no politician who supports the fair tax has ever said it solves all the state's fiscal problems. It is one of the key 2 or 3 things the state needs to do to get its fiscal house in order. So put another way, while it doesn't solve all of our problems, it is essential to begin solving our problems. If we don't pass the fair tax, that structural deficit is just going to continue forever. We're never going to be able to adequately fund schools from state-based resources. Property taxes are going to continue to grow at outrageous rates. Folks are going to be struggling with that property tax burden that grows at way faster than their income grows. Now, this is one of the fiscal reforms that, in addition to the fair tax, we need to do. It's amortizing, refinancing, however you want to phrase it, the pension debt we owe our systems. The red line you see squiggling across the page there, that's our current pension ramp. That's how payments grow under the ramp from year to year to year. You can see it looks like a ski slope. The refinancing, the different payment of that ramp is indicated by those light bluey green bars. So that's what we would replace the ramp with. You notice we're going to put some more money into the pension systems than the ramp requires early on, and then level the payments off. This saves $45 billion in tax increases or spending cuts. Still gets the pension systems 72% funded. They're only 37% funded today. You're healthy at 80. So it brings them very close to healthy, and it does it in a rational way the state could afford. Now, that additional money in the dark green comes in through pension obligation bonds, and that saves taxpayers money in a couple of different ways. Number one, what you're doing is you're replacing debt owed to the pension systems with an asset. So the money that used to be debt is now bond proceeds. So it's an asset that generates a return, saving long-term costs. And then the interest rate you're going to pay on the bonds for these pension obligation bonds at the state level is significantly lower than the interest rate the state is paying to the pension systems. So you save money up front. And you should know that these blue bars include repaying those pension obligation bonds. That's an all-in cost. So all in, even issuing some pension obligation bonds, we still save taxpayers $45 billion. Why this is important? This is one of the key things the state has to do to get its fiscal house in order. But the other thing it has to do is go to the fair tax. And this next slide should convince you of that. Next slide, please. So this is adjusted for inflation. And so these dollar amounts are all in fiscal year or calendar year $2,000. So in fiscal year 2000, in current dollars, we had 40 billion worth of revenue in our general fund. Now go to the far right-hand column, fiscal year 21. We have about 32 billion in revenue, which means over 2 decades, we don't have any revenue growth in our general fund. We have revenue loss. That's after you adjust for inflation. And that's really eye-opening for one simple reason. Back in the year 2000, our income tax rate, that flat rate that applied to individual income taxes, was 3%. Today, it's 4.95%. Our corporate income tax rate way back in 2000 was 4.8%. This year, it's 7%. Collectively, the individual and corporate income taxes generate 40% of our general fund revenue. Despite increasing our rates, on taxes that generate 40% of the revenue that feeds the general fund. Our revenue doesn't keep pace with the economy, and in fact, we have less revenue today after you adjust for inflation than we did 2 decades ago. The structural deficit is driven by bad tax policy. We're spending 20% less on core services now after inflation than we did in 2000 because we don't have the revenue to support them. We are underfunding education. We are underfunding healthcare. We are underfunding human services. We are eviscerating higher ed. And we're doing all that because our tax policy doesn't work. Next slide, please. Now, of course, the economy is not going to turn around anytime soon. This is the unemployment rate, the gray spiky bar that's going on during COVID-19 compared to unemployment rates in the prior years, including the Great Recession. We've never seen anything like this. Our national and state economies are taking a whack from the pandemic that is going to take a few years to recover from, no question. And just putting in context the jump in unemployment rate caused by this virus, I think really makes it clear we can't expect revenue to just turn around when the economy gets back to normal in 6 months. That's not happening. However, I also want to make it clear that if you do need new revenue during a recession, or we may actually be in a depression, we will wait and see how bad this economic downturn is. If you raise taxes the way it's envisioned to be raised under the fair tax, you not only will not harm economic activity or slow down your recovery, you will actually enhance private sector activity and speed up your recovery. And I'll get into the data on what supports that in a couple of slides, but I want to make it really clear that this economic crisis is precisely the right time to pass something like the fair tax. Next slide, please. So here's my horrified taxpayer. Do you love her? I love her. I love her face. So, of course, whenever you've got a revenue problem as bad as Illinois, you've got to raise taxes. And so I just told that to this woman in an elevator, and that was her natural response. Took the quick photo, and there you go. I'm kidding. But I think that's a great horrified taxpayer face. Yes, we do need to raise taxes, and the fair tax is the right way to raise it. So let's talk a little bit about what people are and are not going to be voting on this November. This November, what everyone gets the opportunity to vote on is a constitutional amendment that permits a graduated rate structure. They're not voting on a specific rate structure at all, any rates, in fact. It's just a change to the Illinois Constitution that eliminates the requirement that all income taxes have to be assessed at the same flat rate, irrespective of an individual's income or ability to pay. What the Constitution will say is you may have any rate structure you want, graduated or flat, and then the rate structure will become a matter of law. Now, we know what the rate structure is going to be because a piece of legislation has passed, and I should note on a bipartisan basis, has been signed into law by Governor Pritzker, that if the constitutional amendment does get ratified in November, this new rate structure will become the law of the land automatically on January 1st of 2021. So, does our rate structure and this fair tax approach, this whole graduated tax idea, does it make sense? Is it fair? Is it the right thing to do from a tax policy standpoint? Well, let's talk about the challenges of tax policy. Next slide, please. The reality is, wherever in your state or your nation your needs are greatest, your resources are the least. So for tax policy to work, you literally have to raise revenue from individuals and or areas of wealth and invest a portion of that revenue in areas of need, or you can't provide public services. Tax policy wouldn't work if it didn't have this redistributive aspect in it. It's not communism, it's not socialism, it's something we call math. It's how the system has to work. Now, I'm not the first one to say this. If you go to the next slide, please. The first one to say this is a gentleman by the name of Adam Smith. Has anyone out there ever heard of Adam Smith? I love to ask that question. Adam Smith is the guy that invented capitalism when he published The Wealth of Nations in, bonus question for the class, 1776. America and capitalism born together, meant to be. Woohoo! So, when Adam Smith designed the economic system that is capitalism, he had a lot to say about taxation. This is a quote straight out of The Wealth of Nations. I'm going to read it. I don't like to read from these PowerPoints, but this is important enough that I'm going to. So Adam Smith said, "The subjects of every state ought to contribute toward the support of the government as nearly as possible in proportion to their respective abilities, that is, in proportion to the revenue which they respectively enjoy under the protection of the state. As Henry Home Lord Keynes has written, a goal of taxation should be to remedy inequality of riches as much as possible by relieving the poor and burdening the rich." You say that again. A goal of taxation should be to remedy inequality of riches as much as possible by relieving the poor and burdening the rich. That is a core principle of capitalist tax policy. Now, why did Adam Smith say that? And it had everything to do with bargaining power. He theorized that if you actually implement a capitalist economy, folks at the top of the income ladder, the owners of capital, would have significant bargaining power advantages over what he called, quote unquote, mere laborers. So much so that the owners of capital will be able to take, through the bargaining process, a portion of the value created by laborers for the economy away from laborers and put it in their own pocket. So they will get a disproportionate share of income growth over time because of superior bargaining power. Not evil or immoral, but how the system would work. So if the system would work so that people at the top of the income ladder would get a disproportionate share of income growth over time, then they should have the greatest tax burden as a percentage of income to pay for the government that in turn supports the economy that gives them this benefit. Was Adam right? We could test that with data. Next slide, please. This is Illinois-specific data. This is our state. Look at the comparison in the far left column. So from 1979 through 2017, the wealthiest 1% in our state saw their incomes, this is after inflation in real terms, increase from an average of $411,000 per year to $1.45 million a year. That's an increase of 254%. Now go to the next comparison at the far right. Everybody else, the bottom 99%, saw their average income increase from $51,000 to $61,000, a 20% jump. Do you see a slight disproportionate share in income growth over time? I hope this graphic makes that pretty clear. Now, what's really interesting about the bottom 99% is most of them didn't share in any of that growth. In fact, if I had a column that showed the bottom 90%, after inflation, they're actually earning less today, the bottom 90% in Illinois, than they did in 1979. It's only the top 10% that saw any growth in income over this entire sequence. But you need a tax that could respond to this reality. And I've got news for you. There's only one tax that can do that, and that's the income tax. Literally every other tax or fee available to state or local government, every single other one, sales tax, property taxes, excise taxes, fees for like driver's licenses, etc., are all regressive. They all take a bigger chunk out of the income of a low to moderate earning family than they do out of an affluent family. The only tax that could be designed to actually respond to how income is distributed in the modern economy is the income tax, and then only if you can have a graduated rate structure that imposes a slightly higher tax rate on higher levels of income and a slightly lower tax rate on lower levels of income. That is the only way you could respond to this reality. And if you took my master's course that I teach at Roosevelt University on tax and budget policy, you would know that it is textbook tax policy to use the income tax to create fairness among people that have very different income levels by imposing graduated rate structures. It's what the income tax is supposed to do. It's supposed to create some fairness. It's supposed to respond to ability to pay. It's supposed to respond to how incomes get distributed in the modern economy. Next slide, please. Now, this is a little hard to follow slide, but it's a really important one. So it shows how regressive tax policy is or isn't in different states, those with flat rate income taxes and those with graduated rate income taxes. And basically what the graphic shows you is taxes are far more regressive in every state in America. That is, they take more out of a lower moderate income family's earnings than they do out of an affluent family's earnings in every state that has a flat rate income tax versus every state that has a graduated rate structure. Next slide, please. Not surprisingly then, in Illinois, which has a flat rate structure, we have a highly regressive tax system. So this is tax burden as a percentage of income in our state. Far left is tax burden for the bottom 20% in income earners. Then you go bottom 20%, 40%, 60%, 80%, all the way up to the wealthiest 1%. So you can see everyone at the bottom and middle pay a greater percentage of their earnings in state and local taxes in Illinois than do the wealthiest in our state. This is one of the primary reasons we have a structural deficit. Think about it. We've had this huge explosion in income inequality over time. And all the taxes that the state has the ability to levy are regressive. They all focus on low and middle income families who are losing income over time. The only tax that could capture what's really happening in the modern economy is the income tax, and then only if it has that graduated rate structure so it could respond. We don't, so we have this regressive system. Next slide, please. And we have a structural deficit. Now, this is sort of the kicker slide. Only look at that far left-hand comparison. This compares average income for the wealthiest 1% in our state to the bottom 20, 40, 60, 80%. But the far left comparison is the bottom 20%. So the gray bar shows you that before Illinois taxes are assessed, the wealthiest 1% in our state have an average income that is 137 times greater than the average income for the bottom 20% of earners in our state. The red bar shows you that, however, after you impose Illinois state and local taxes, the wealthiest 1% have an average income that's 149 times greater than the average income for the bottom 20%. In other words, our taxes are so regressive, we actually worsen the income inequality that's happening in our private sector economy. Someone needs to defend that to me, because I can't think of any policy objective that is served by worsening the huge growth in income inequality that's naturally occurring in our private sector economy. Next slide, please. So here is the new rate structure. If you go to the middle of that slide, the 4.95%, that's our current flat rate. So once again, this is not what you're voting on. This is the rate structure that will automatically become law in January of 2021 if the constitutional amendment that permits a graduated rate structure gets ratified in the November election. What you could see is this is your taxable income. So what's that mean? These income brackets, it means your income left after you've taken out all your credits and all your deductions and all your exemptions. It's literally what's going to be taxed. It's not your gross earnings, it's your taxable income. So all taxable income under $100,000 in Illinois is taxed at a rate lower than the current flat rate. Then the current flat rate applies to that portion of your taxable income that's between $100,000 and $250,000. When you get over $250,000 in taxable income, then the tax rate starts to jump up. What does all that mean? How does this shake out? Next slide, please. So here's how it shakes out. It works pretty well. It actually cuts tax burden for 97% of the folks who file an income tax return in Illinois. 97%. Now, it doesn't cut them by a lot. It's a very modest tax cut, but still it's tax cut. It does increase taxes on only the wealthiest 3% of income earners in Illinois. Now, pre-COVID-19, that would be enough to raise $3.6 billion in revenue. Obviously, it's going to raise less in the current economy, but not as much less as you would think. How do I know that? Well, the statistics on job loss are compelling. 35% of the jobs that are being occupied by lower middle income families have been lost during the recession. 35% of those jobs. Only 2% of the jobs held by higher wage folks have been lost during this recession. So the recession is disproportionately banging on low and middle income families. So affluent families aren't going to see quite as much damage. They're going to see some, it's inevitable, but they're not going to see quite as much damage as low and moderate income families, which means the fair tax, if it does become law, will generate not quite the $3.6 billion, but it'll generate around 3 or maybe 2.9, significant new revenue. Our new top tax rate is 7.99%. It kicks in at $750,000 of taxable income for an individual and $1 million of taxable income for people that are married filing jointly. Compare that to the top tax rates in other Midwestern states that have a graduated rate structure. Minnesota, the top tax rate is 9.85%, much higher than what ours would be, but it kicks in at only $163,000 of taxable income. Iowa already has a top tax rate of 8.5%, and that kicks in at $71,000 of taxable income. Wisconsin already has a top rate of 7.65%, but that kicks in at only $250,000 of taxable income. Our top rate doesn't kick in until 3 times that amount almost. So the bottom line is the proposal is pretty rational, and it fits nicely within national norms. And it's really not a crazy sort of eat the rich strategy. In fact, the next slide will make that clear. Next slide, please. So this compares tax burden as a percentage of income under current law versus what it would look like under the fair tax. So current law is the red line. So as you can see, the wealthiest 1% under current law only pay 7.4% of their income in state and local taxes. If the proposal passes, then the blue bar becomes new tax burden as a percentage of income. And what you can see is, yes, it's a very small tax cut for 97% of the state, but look at the top. The wealthiest 1% will go up from paying 7.4% of their income in taxes to 10.8. That is still the lowest tax burden as a percentage of income for any income group in the state. This isn't some out of control tax policy. This is a very rational utilization of the income tax for the express purpose you are supposed to utilize an income tax in your overall tax system. Next slide, please. Well, will raising the tax destroy our economy? Let me think about it. No. So that has never been the case. In fact, there's never been a study that's peer-reviewed that finds any statistically meaningful correlation between state or even federal tax policy and job growth or economic growth. They are independent variables. They're not related to each other, but you hear this malarkey all the time. Next slide, please. And then you have 2 recent examples of cutting taxes on wealthy people. Go back. Kansas and Minnesota, there you go, thank you. Cutting taxes on wealthy people versus raising taxes on wealthy people and how it impacts the economy. So Kansas, they had Governor Brownback come into office about a decade ago, and he literally said, use us as the test case. We're going to cut taxes on the job creators. You could hear that as rich folks. And we're going to cut their taxes so significantly that it will free up their income to create jobs for everybody else, the trickle-down effect. And it'll trickle down and create so many new jobs that here's what will happen. Kansas's economy and job growth will go at rates faster than the Midwest and the nation. Because we'll have all these new jobs from the trickle-down effect, we won't have any deficits. The tax cut will pay for itself. Where have you heard that before? Tax cut will pay for itself. And we'll be going along swimmingly, no deficits, great economy. Well, he did. He cut taxes on the wealthiest. The problem is there was no trickle-down effect. So there was no jump in job growth. And in fact, Kansas's job growth fell behind the Midwest and the nation, which meant their deficits exploded in Kansas. They exploded to the point where they cut spending so significantly on K-12 education, for instance, that the Kansas Supreme Court actually ruled the cuts had to be restored because they denied Kansas children the opportunity to attend a quality public school. Oh my goodness. Now let's flip that story to Minnesota. Around the same time, Governor Dayton came into office there, and he inherited a hot mess. Like Illinois, he had a big structural deficit and a big accumulated deficit. His deficit was $6.2 billion, and his state has a population about the size of Cook County. That's an amazing deficit. He had a huge unemployment rate, very high, 7%, and a terrible economy. Only 4,000 jobs had been created in Minnesota over the prior 7 years combined, not per year, combined. They had bridges falling apart. They needed a capital program. They were underfunding schools. So Governor Dayton said, look, I got to raise taxes, and I'm going to do it the right way. I'm going to raise it only on rich people. So he bumped up his top income tax rate from 7.85 to 9.85%, one of the highest tax rates in the country. What happened? 4 years later, the state had produced 172,000 new jobs. Their unemployment rate was way down. Their deficits were gone. In fact, they had a surplus. No correlation at all between the huge tax increase he implemented on specifically rich people and harm to the economy. In fact, they didn't have harm to the economy. Their economy went well. Next slide, please. And in fact, that's pretty much what you see with all the high tax states. So there are 41 states in America that have an income tax. 9 states don't. And in the 9 states that don't have an income tax include the miracle economic states, the anti-tax people like to talk about, the Texases and Floridas and North Dakota, Nevada, all these states that say, oh, these miracle economies, and they try to say they have a miracle economy because they don't assess an income tax. So this compares economic growth in those 9 states that have no income tax at all, not just a low income tax, no income tax, over the last 10 years, to the 9 states in America that not only have an income tax, but have the highest income tax rates, your Minnesotas, your Californias, your Connecticut's, your New York's, et cetera. The high tax states are the dark, it's supposed to be blue, but really kind of looks like a black bar. And the no tax states are the red bar. State GDP growth, way higher in the high tax states over the last decade than in the no tax states. Then go to personal income. Again, higher in the high tax states than in the no tax states. More important, growth in disposable personal income. This is what people have left after taxes. Higher rate of growth in the high tax states than the no tax states. And then finally, hugely important, personal consumption, higher in the high tax states than the no tax states. Now, when I first started talking about the fair tax is going to come and that it won't harm the economy and in fact could be good for the economy, here's what I was talking about. The economy is based on consumer spending. 68% of all economic activity at the state or federal level are you and me buying junk and such in the consumer economy, services and trinkets. Well, our best spenders are low and middle income families because they don't save. In economic terms, they have what's called a high marginal propensity to consume, meaning every additional dollar they get, they spend it in the local economy. It also means every additional dollar you tax them, they take spending out of the local economy, harming economic activity. Wealthy people, you saw the huge disparity in income growth over time. Wealthy people have very low marginal propensities to consume. What does that mean? It means for every additional dollar they get, whether through earnings or a tax cut, they're unlikely to spend it. They're already spending everything that they want to spend given their growth in income. Similarly, if you take some of their income away through taxes, they're unlikely to decrease their spending patterns because they have so much growth in income, they could absorb the tax increase and still maintain their lifestyle. So when you have to raise taxes coming out of a recession or during a recession, you want to focus the tax increase on the top of the income ladder where people aren't going to change their consumption patterns. And if you can, you want to relieve some taxes on low and middle income families because they'll take that tax relief and spend it in the economy, creating jobs. That is precisely what the fair tax does. That is why the fair tax works. This is not my economic analysis. It's the economic analysis of Nobel Prize winning economist Joseph Stiglitz. It's been proven to work. He did win a Nobel. It's pretty nifty. And it's also a similar analysis by Republican PhD economist Mark Zandi at Moody's.com. And I know he's a Republican because he was Republican Senator John McCain's top economic advisor when McCain ran for the presidency against Barack Obama a few years back. So both the Nobel laureate and the Republican PhD have found the same thing. Illinois needs to follow this example and pass sound tax policy like this fair tax, especially during a difficult economic time like we're having now, because it will increase consumption by low and middle income families, creating an economic boom, and it will raise taxes on those that won't decrease their spending patterns and not harm the economy. Next slide, please. Now, I have heard a lot of arguments against the fair tax that are borderline hysterical fear-mongering and certainly aren't based at data. One of my, I don't know if I should say favorites or least favorites, I don't know which is the best way to say, is that the fair tax is really a camel's nose under the tent. Sure, this version of the fair tax cuts taxes for low and middle income families and only raises taxes on rich folks. But once they have it, my gosh, they are just going to keep raising taxes willy-nilly and everyone's going to pay more. So we said, all right, let's see if that's what's happened in other states that have a graduated tax. So 32 states in America have a graduated rate structure, 9 have flat taxes. Over the last 20 years, for those 32 states that actually have a graduated rate income tax, 80% of them didn't change the rates at all. No change, nothing. 13% of them, cut their taxes without general cut rate. Tax rates. 5% did pass a general tax increase for everybody, and 2% passed a tax increase that only applied to the wealthiest. So if other states with a graduated rate system are a guide, then if we had one, there's an 80% chance there'll be no change in rates, not some willy-nilly increase, no change. But if there is a change in rate, based on the actions of other states, we are twice as likely to see tax cuts for most people than we are tax increases. So what are they talking about? And the answer is nothing. They got nothing. They have no data. Next slide, please. And then they claim, well, then millionaires are going to leave and everyone's going to out-migrate and blah, blah, blah. Once again, there's never been a peer-reviewed study that finds any statistically meaningful correlation between migration and tax policy. Other things matter, but tax policy doesn't. I'm not saying no one ever left or moved because of taxes. Of course, somebody did. What I am saying is there's not a statistically meaningful correlation. The things that drive migration, there are 4 of them, are number 1, somebody gets a job in another state, they move. Number 2, family reasons, kids grow up, they have kids, grandparents move to be near grandchildren, or vice versa, kids that get married move with their children to be near their grandparents, etc. Number three, and this is going to be hard to believe because we live in Illinois, but nonetheless it's true. Apparently, some people like nice weather. And so they move to be in a state that has nicer weather. If you live in Illinois, you don't live here for the weather. And then number four are housing prices. So there's just no correlation. In fact, in Illinois, we've had out-migration every year since 1925 except one, and that out-migration slowed down in years of tax increases. Next slide, please. And as for millionaires, let's just talk about California. So California increased its top income tax rate in the year 2013 from 10.3% to 13.3%. That is the top tax rate on millionaires in the country. The graphic shows you, go to 2013 in the middle of the chart. Every year after that tax increase, they had a growth in the number of millionaires over and above the prior year when they raised the taxes. What are they talking about? Millionaires didn't go running screaming out of California. It grew. Minnesota saw the same thing. And in fact, California has a net migration in of millionaires. So this is the summary. That's the last slide in the presentation. There's never been any data to support any of the arguments the anti-fair tax people are making. None. There's no data supported. If you pick up just a textbook on tax policy, what you will see is the income tax is the only tax that can be used to create some fairness among taxpayers that have very different levels of income in an economy that has worsening income inequality. If we don't pass this fair tax, that structural deficit I showed you will never, ever be addressed. It's one of the 2 or 3 key things we have to do. It doesn't solve all our problems, but it's a major step forward. If we don't do it, here's what will happen. Structural deficit continues. We continue to over-rely on property taxes to fund schools. We continue to underfund our pensions and create a fiscal nightmare in our state. Oh, and by the way, any future tax increase would have to hit low and middle income families because we'd be stuck with a constitution that requires a flat rate. Only by changing that constitution do we even have the opportunity to create a new tax policy that doesn't go after low and middle income families and only goes after the affluent. Thank you for listening. I'm sure there are no questions.
Thank you, Mr. Martire. That was so informative. In fact, I think you must have done an excellent job because there aren't many questions in here. One person said, if property taxes are lowered and personal income tax raised, doesn't that benefit the top 1%?
No, over time, property taxes need to come down because we over-rely on them. And it would really mostly benefit low and moderate income families because property taxes are highly regressive. So the bottom line is here, that change in policy over time would benefit low and middle income folks from a tax incidence standpoint. It will benefit small businesses and frankly would lead to a more equitable school funding system. So it's a long-term change we really need to go to, but it's a long-term change. I mean, those property taxes sadly aren't going to jump down in year 1 or 2 or 3 or 4 after the fair tax. They'll start coming down maybe in year 4, but we need the fair tax to at least begin down the road to rejiggering our tax policy, our tax system to work in the modern economy and take some of the pressure off these property taxes.
Okay, another question. Is there a theory on when property taxes will be reduced?
Yeah, like I said, it's going to be over time. So what will have to happen is the state will have to do a couple of other things, right? They need this revenue. They need to re-amortize the pension debt. They need to fix their sales tax base. But let's assume the state starts getting its fiscal house in order and starts putting more money into K-12 education. Once they get to a certain tipping point, and that would be about an additional investment of about $3 to $4 billion. It'll take them 4 or 5 years to do that, even with the fair tax. Then property taxes will start to flatten out, and eventually go down. And that's actually been our track record in Illinois. So it's going to take a while. I don't sell snake oil. It's not something that happens overnight, but it is the long-term consequence of going to better tax policy and restructuring your tax system.
Kathy?
Oh, do you,
Okay, do you,
I'm sorry, what?
go ahead.
Do you have a good feeling about the fair tax passing? Have there been any, polls taken or anything, or?
I do tax policy for a living. I'm immune to good feelings. So it's just not what I have. So yeah, I'm very involved in the polling. I'm on, there's I think 4 ballot committees that have been put together statewide. I'm on the steering committee of one of these ballot committees. They are doing polling data all the time because J.B. Pritzker has given them gobs of money to do it with. And it looks pretty good, but very, very close. And here's the problem. While it polls where you want it to poll, there's always a drop-off at the election. So we really need a lot of grassroots organizing at the local levels to get people to vote for the fair tax in this general election, because even though people support it, the drop-off could be enough to kill it. And so the state would support it in polling data and then not pass it at the ballot box, and that would be a shame.
Mm-hmm.
Okay, will pension income still be exempt from the new tax?
Yeah, this is one of the scare tactics being thrown out by the anti-taxers. There's absolutely nothing in this amendment or in this approach that makes it in any way more likely that retirement income would ever be taxed in Illinois. It's exempt. We're one of 3 states with a general income tax that exempts all retirement income. It's us, Pennsylvania, and Mississippi. And you always want to be mentioned in the same breath as Mississippi, I think. So the bottom line is there's nothing in this that would change that. ARC supports the fair tax, the senior citizen advocacy group. And in fact, they have one of these ballot initiatives. And one of the reasons they support it, they understand if the fair tax becomes law, it is far less likely that the state of Illinois will ever go after retirement income from a tax policy standpoint. However, if it doesn't pass, you saw how bad our fiscal condition is. In a year or 2 or 3, they might. And I still don't think they will. I think retirement income is one of those things that Illinois is just never going to tax. There's not a lot of political will to do it. But if anything is going to create the pressure to change that, it would be the failure of this initiative and the continuing deterioration of the state fiscal system.
How much of the deficit is unfunded pension liability? I think you addressed that in your...
Yeah, it's, well, the deficit is really just unpaid bills for services. The deficit growth is now being driven by 2 things. That pension ramp, you remember that payment that kept growing every year? So what you have to understand about that is it's not a pension problem. That's not the cost of funding pensions or anything inherent to the design of the pension systems. That's the debt service plan for repaying what was borrowed against the pensions. So if we borrowed that money from a bank, we would just call it a loan. We borrowed it from the pension, so we call it unfunded liability, but it's the same thing. And the repayment plan was crazy backloaded because in 1995, they kicked the can down the road. They basically said, we're going to create a quote unquote repayment plan that for the first 15 years continues to underfund the pension so we don't have to deal with the problem and then throw the problem on down the road. So yeah, it's creating fiscal pressure now combined with our poor revenue growth. But you got to remember, it is a symptom of that structural deficit. It is not the cause of our deficit. And unless we re-amortize that pension debt, as I showed you, in addition to making the fair tax the law of the land, we're going to have some significant ongoing fiscal problems. No one thing solves them all. They're too big at this point.
Why do they use the average for the top 1% income and not the median?
you don't get remarkably different numbers for the average or the medium. I think the average income is a little better at the top 1% because there's so few taxpayers in there. And the same with average income for everybody else. You could run the numbers yourself if you want to take it. Pull the data from the IRS. We got all our data from publicly available data systems and did simple math. So if you want to do it with a median, go knock yourself out. You will still see a massive growth in income inequality.
Why would,
Okay,
I'm sorry, Kami, go ahead.
go ahead. I didn't know if you saw the questions.
Why, after listening to this presentation, why would anyone not vote for this?
You know, ideology, and a lot of people don't get this information. So a lot of people are anti-fair tax, anti-tax, period. And you've heard all the stuff. You're gonna encourage millionaires to leave the state. You're gonna stifle the economy. You're gonna create job loss. There's some very bogus study that came out of some university recently that was paid for by a chamber of commerce that made all these conclusions. And, you know, we asked them for their data, they won't give it to us. We asked them for their modeling, they won't give it to us. But they literally mouth off all these ideological things that literally run counter to all the data and information. And I'm sure if they were willing to release the information, we could destroy them just from a data standpoint, which is why they're not willing to release it. So the bottom line is it's ideological, and there's scare tactics that are being used to drive people away from supporting this. I mentioned a few of them, you know, the camel's nose under the tent argument, the millionaires will leave argument. There's no data to support any of them, but nonetheless, they make it. I did a debate this morning for a small business group against Leslie Munger, the former comptroller, and she had some data from some group, and I don't remember the group, some right-wing group, that said, so this isn't enough money to solve all our problems. So here's what we think the income tax rates will be to solve all our problems. And then they had some numbers that like 13%, 20%, I don't know what they were, top income tax rates, just purely conjecture based on nothing, not tied to one iota of data, but to scare people. Oh my gosh, if we get a graduated rate structure, are they really gonna have a 15% top rate? No, but whatever. So it's ideological.
How badly was the state finances impacted by not having a budget for 2 years?
It destroyed us. So going into, we had the temporary tax increase. I don't know if you remember. So in 2010, so for fiscal year 2011, the state temporarily increased its individual income tax rate from 3 to 5% and made a corresponding change in the corporate rate from 4.8 to 7%. So here's what happened. That was a temporary tax increase that was in place for only 4 years leading up to the election of Governor Rauner. When that temporary tax increase passed, the state's accumulated deficit was just at $16 billion. The last year of Governor Pat Quinn, before Rauner took office, they had paid that deficit down to $5 billion. So they'd done a really nice job of reducing the deficit with this added revenue from the tax increase. And then under Governor Rauner, he said, I want to let that tax increase sunset the way it was supposed to under law. So it went away and the tax rate went down from 5% to 3.75%. And he didn't pass a budget. So a bunch of expenditures happened by court order, et cetera, but we had no revenue to cover them because of the scale down of the tax rates. So the deficits again ballooned in the first 2 years under Governor Rauner to the point where they got up to 12 billion again. And then over Rauner's veto, his third year in office, there was a bipartisan vote that passed a budget and passed some tax increases to pay for it. And they started paying the deficit down again. And that continued on through the first couple of years of JB. So the deficit is now down to about 8.4 billion when it used to be at the height of the Rauner administration, 12.5, 13 billion. So once again, they've used the revenue to pay down the deficit, But now we're kind of stuck because we do have that pension ramp, debt service payment rising, and overall, because of the structure of our tax system, the rate changes really aren't what we needed to do. We needed to change the rate on a graduated basis. Just doing it on a flat basis, it's problematic because too many people are losing income. And so, as you saw from the one graphic I put up there today, overall revenue growth or revenue is less today than it was 20 years ago.
Well, Mr. Martire, we're approaching the end of our session now. I think we've addressed the questions that are in the chat. I want to thank you so much for a very informative presentation on the fair.
Well, thanks for inviting me. It's always a pleasure to work with the league.
Well, thank you. And thanks to everyone who came as participants. We really appreciate your efforts to be informed voters. And I will close our meeting now.
I had one more question.
Oh, do you have a question?
Yes, my question
Okay,
was,
Bernice.
somebody said to us that the ballot is such that it's a trick question. And I don't understand what they meant, but is it going to trip us up to not be able to vote for it?
Yeah, I don't think it's a trick question. I mean, it makes it pretty clear that you're not voting on any specific rate structure, then there are no rates available in the Constitution. It's just a permissive amendment that would allow such a structure. Frankly, it would allow continuing a flat rate. It doesn't require a graduated rate structure. It's just eliminating any restriction in the Constitution that you have to have the one rather than the other. And so I don't think the language is that confusing, but you know, I would need to know the specifics of what they found misleading in the question. And maybe I'm a little too close to it to see any misleading part in that question.
I did have one question, if I might.
Go ahead.
One thing I noticed was the Illinois personal exemption is really low. Would we have not been much better to have increased the personal exemptions? And that would have impacted the lower income much.
Yeah, no, it wouldn't have helped the lower income as much as upper and upper middle income, because lower income don't have enough money to take full advantage of a lot of the deductions and credits. The way those things work is they tend to not be very progressive. And it's really hard to make them progressive, because when you try to do that, then all kinds of lobbyists weigh in and you end up with a broad general exemption that does carry up the income ladder. It's much more precise to do it through your rate structure. But to your point, is it possible to design such a system that would be progressive? Yes, it is. It's just very hard to implement.
And the other question is, why is this not a marginal income tax rate? It's really a flat. Once you hit like the 500,000, did I understand correctly that it's unlike the federal tax structure where it's marginal income is taxed at the higher rates? Was there a reason they didn't choose to do it like that versus?
Well, they did do it like that, except at the very, very top rate. So it's way above that. So if your income, if you're taxable, remember it's taxable income. So if you're single and you have taxable income below $750,000, you get advantage of the marginal rate structure.
Okay, so it is marginal.
And if you're married and filing jointly, you get advantage of the marginal rate structure if you have under $1 million of taxable income. However, if you have $1 million or more and you're married, or $750,000 or more and you're single, no marginal structure, flat rate of 7.99%.
I think that's the biggest thing that isn't known, because when you read the documentation, it doesn't say that.
Yeah, I don't think they're as clear on that. I completely agree with you on that, number one. And we ran some, that's not, if we were to design it, if my organization wrote this bill, which we did not, we were an advisor to all the people that wrote it, and they took a lot of our suggestions, but not all of them, by the Lord above. And so we would not have done that, but then we modeled it out, and we think it creates a tax unfairness issue for about 4 filers who are very wealthy, literally 4 tax returns. Mm-hmm. So it doesn't impact a lot of people.
Okay. I think that's the biggest thing that isn't known. I think when you do these numbers and they look at it, they're like, oh my goodness, you know, I could be hitting, you know, the 250 in the next few years, and now I'm going to go to 8%, you know, and I need to.
Yeah, that's not how it works.
Okay, good.
All right.
All right.
No, thank you.
Again,
Great question.
Thank you very much. All right. We'll say goodnight to everyone then.
Ciao.
Good night. Thank you.
Thank you. Good night.